Before we head in this week, just a reminder for any level 1 candidate, whether you're a subscriber on markmeldrum.com or you're not, whether you have access to the applied level or you do not, on Discord, on the applied level Discord, on Monday we have 2 days of office hours for level 1. These are Q&A sessions. The exam starts this week. Some of you may have lingering questions hanging out. I don't get this, I don't get that. That's what this is for. It's a two-day blitz on office hours. If you have the applied level and you are level 1, make sure you hit me up to give you the level 1 role. You may not have that. You'll need the level 1 role to attend these sessions. If you're not an applied level subscriber, but you're a markmeldrum.com subscriber and you want to join in on the Discord office hours, just click on any level 1 module, and on once you do that, on the right of your screen you'll see the join Discord link. If you're not a markmeldrum.com subscriber, you can open a free account at markmeldrum.com. Once you do that, click on the level 1 2018 video folder, and on the right of your screen you'll see the join link. When you first get into the channel, you'll see something like this. I'm clicked on Q&A feed here, that's why you see this, but at the very top of all the channels you'll see 9 events. Click on events and it'll tell you when the office hours are. So tomorrow at 9 a.m., that's Eastern time, tomorrow at 9 a.m., level 1 economics office hours. I'm going to be hosting this one, and then at 11:30 there's derivatives for level 1. I'll be hosting that one as well. 2 o'clock is quantitative methods. 4:30 derivatives, I'll be doing that one. So we have 2 sessions for derivatives, 2 sessions for quant, and then we get into a Tuesday. At 11:30 fixed income, I'll be doing that one. You have financial statement analysis. There's another fixed income which I'll be doing as well, and then you have financial statement analysis. So I'll be handling the office hours for economics, for derivatives, and for fixed income. Who else do we have? Richie will be doing quantitative methods for level 1. Mac will be doing also quantitative methods for level 1, and Darren Kerr will be doing FRA or FSA on Tuesday. So we have a whole bunch of office hours meant. The time is meant to appeal to both European markets and North American markets. So when we say 9 a.m., that's meant to appeal more to a European market. That's 3 in the afternoon in Europe. 1:30 for or 11:30 for derivatives is 5:30 in that market as well. So that's why there's 2 sessions to appeal to both North America and to Europe. You can attend all of them. This is just before the exam. This is level 1 just before the exam. Next Monday and Tuesday, we'll be doing the same thing for level 2. So there is the schedule. All you have to do is click on events and you'll get the schedule. To get into the event, just scroll all the way down and you'll see level 1 special event. You click on that. There's the level 1 special event. You just click on that one and you're in. Okay, another Sunday. I'm back in Canada now. My voice is starting to get a little bit better. I got very sick in Rome last week, and I wasn't getting any better, so I flew out on Tuesday. Now I'm back home, and I've got this long tail cough that I just can't get rid of right now, so we'll see how long that lasts. Let's go through the week that was. We did have a Fed meeting. I didn't agree with the outcome, but it was expected. No cut. I thought they had permission to cut. And we'll look at the press conference. We'll use AI to look at the press conference. How's that sound? Next FOMC is 38 days away, and you can see 83% on zero, and I think that is another mistake. I think the Fed had permission to cut. I think they're ignoring half the story that's out there and only paying attention to one half, and we'll get to that shortly. Let's look at the week that was. We'll separate it here. We can see our money market rates holding very close to the zero line. They will trace or follow the Fed funds rate, which is sitting at 4.33%. They really won't budge until the FOMC cuts rates. Looking at the capital market curve, slight steepening across the curve. And I think we're going to have to start really paying attention to our two major key rates here, the 5-year and the 10-year. Your auto loans are tied to the 5-year, your mortgages are tied to the 10-year. And a lot of consumer credit is priced against the capital market curve, not the money market curve. Institutional borrowing, especially for banks, is tied to the money market rate. Repo market's tied to the money market rate, so that is beneficial there when those rates come down. But for the consumer, it is the capital market curve. And as far as refinancing the debt that is coming due this year, much of that debt is going to have to be priced out on the capital market curve, which is market set. Besant has been vocal that the goal is to get not just the overnight rate down, but yields down across the curve. I don't know if we can say that they're doing a good job at this. If we look at from beginning of year to now, we started the year with the 10-year at 4.58. We're down 21 basis points, but we were down more than that before. 450 is the pivot point on this one. You breach 450 to the upside and market momentum can begin to carry it. It's under 450, but to really start to matter, you've got to get that under 4. That's when we can start to see some success. I don't know that we're going to get that on the long end of the curve until you start getting something more on the short end. And with this going on, I think we are here for a while. TLT, which is a portfolio of bonds that are sitting between the 20 and the 30 year. Its average maturity is about 25.5 on TLT, which gives it a duration of about 16. A duration means its sensitivity to changes in rates. It would be expected to change 16% for a 100 basis point move. So if we extrapolate between the 20 and the 30, we're about 4.85. You can get that down to 3.85. TLT would increase by about 16%. It has not been performing well at all, to the point where I am near the end of waiting for this to perform. When you hang out with an asset class long enough and that asset class isn't doing the job it's supposed to be doing, well, then you have to ask, what am I doing in that asset class? I'm nervous about U.S. duration at this point, and I'm also nervous about exposure to the U.S. dollar. So I am on daily watch as to saying, do I want to get out of this thing? I have been reducing my position using options. You sell some options, you earn some premium, you use what you earn to take offsetting losses against that, such that you don't make anything, but you don't lose anything. But that's going to take some time, and I'm more worried about the downside. I've become more concerned about TLT sub 85, sub 84, because it's simply just not performing. And the poor execution on the trade front from the administration is just not helping. The slow realization that with everything they're trying to get done, they're actually going to make the deficit worse, not better. Meaning that the debt will increase at a faster rate than previously thought. And if that's the case, it raises the long end of the curve, which makes the interest expense higher, which raises the deficit, which raises the debt at a faster rate. And you have this cycle that keeps pushing the long end of the curve up. And being that we have not seen any kind of execution intelligence out of this administration, I have very low faith that if a situation like that arose, that they would know how to fix it. I think Trump would just threaten the bond market and hope for the best. And if that didn't work, say, oh, I never threatened the bond market. I never said that. We have some inflation data this week. U.S. CPI in 2 days. This is for April. PPI in 4 days. Last month, the data came out, I thought, with permission to cut. We're only talking 25 basis points from 4.25 to 4.5. 25 is not that much from that high level. You had permission to move forward, but you didn't. Retail sales as well. You get both sides of the equation. You get the cost side, and you get the willingness to consume side. And then, of course, you get the soft data, consumer sentiment. The soft data has not been good at all. The hard data is held up, but as Powell said in his press conference, we have not yet seen the effect of tariffs. We saw some front running. Q1 GDP. Imports took away 5% of Q1 growth. So we have seen a lot of that, big rise in inventories. We're going to look at some shipping data out of China to U.S. ports. We're going to see that there is a drop-off there. We're starting to see it, but it hasn't shown up in the hard data yet. This is retail sales for April. This will reflect the imposition of tariffs because they started, April 9th, announced on April 2nd. They started on April 9th, the 10% across the board, but the reciprocals are gone. Let's see what it did there. This will be important. U.S. CPI, it's for April. So it depends on what part of the month that they surveyed in. If it's after the 9th, those 10% tariffs were in place. We'll see if it actually had any effect. And we got to keep in mind here that the U.S. economy on a nominal basis is a $30 trillion economy. Imports are about $4 trillion of that. And some, I think, 800 billion is exempt. So there's about 3.2 trillion that would have a tariff on it coming into the economy. And the majority of U.S. GDP is made up of services, not goods. So even though we think 10% across the board, it's not going to be 10% on the final price. So I'm not expecting to see much out of CPI. I'm expecting it to be quite benign. Retail sales will be important. What I think the Fed is missing, and they made it quite clear in their press conference, this level of uncertainty about the tariffs. We don't have clarity on that. The soft data is terrible, but the hard data is pretty good. The economy's in a good place. Monetary policy's in a good place. He said that, I think, 9 times. But he's focusing on one threat to price stability, which is the threat to the upside. Technology is deflationary. The tariffs only affect the goods that are imported. Only the goods that are imported, and goods are a small part of the overall U.S. economy. Services are the bigger part. I'm going to spend some time this week on AI and what I've experienced in using it for the last month, and now I'm using the experimental version of Gemini 2.5 Pro experimental. You need a subscription to get that. 3 letters, WOW, as the kids say. Wow. This has the very real potential to be deflationary on the services side of the economy, which is the way bigger side, and not a single word about it. No word about the uncertainty associated with the deflationary forces. And these are big. Whatever you think this is going to be, you are underestimating exactly what it's going to be. This is big. But nothing there. Only we're concerned about upside risks to price stability from the tariffs. Last time it was transitory. Now we're uncertain. He said both the economic and the price stability mandates, the risks to both have risen. But last time it was transitory. And not one word about the deflationary effects of technology. So I think this Fed has made a mistake by not cutting. I think they're setting themselves up to make another mistake. Now, in all fairness about the mistake in not cutting, if we were calling errors, you got to give that error to Trump. If he said nothing, if he didn't threaten Powell, if he didn't say lower rates, if he didn't do any of that stuff, the FOMC might have thought, you know what, we're good to cut rates. But because of all that, there might have been some thinking, if we cut rates, it's going to look like we're bending to the will of the president. And that could cause a whole bunch of problems because now the market will question our independence. So now we cannot cut rates. Now we have to dance around why we didn't cut rates. So we got to say uncertainty a lot of times. We got to say we're in a good place. We got to really show that we've come to this decision. And maybe that is why he repeated himself so many times, is who you trying to convince, us or yourselves. If you're calling an error, I think you got to give this error to Trump. Had he said nothing, it is quite possible you could have had a rate cut and the market accept it without any fear of the discussion of Fed independence. Now, June, hopefully Trump can be quiet until then, and we might get that rate cut. Reverse repo and reserves, really nothing much to see here. You do have some Fed speak this week. Thursday, 8:40 a.m., you have Powell speaking. I think that's the only one that matters. Looking at the week, TLT, not a good week. SPX, not a good week. The dollar index did recover a bit, up 0.35. Fed funds futures, Q2, 5 basis points, and basically saying nothing much is going to happen here because this is the only one. June 18th is the only one to end Q2. Q3, 31.5. So at least one cut, maybe a bit more. Q4, at least one cut, maybe a bit more. There's the 2 cuts that were penciled in. By the way, for June, we get the summary of economic projections. That'll be interesting. Every time I say that, that'll be interesting, because everything just changes so quickly. Remember when nothing changed? Do you remember that? The birds were singing, the flowers smelt nice. It was this nice cool breeze. Not now. By the end of the year, 67.5 basis points. 2.5 cuts in 5 meetings. Going into Q1 next year, you got another 21 basis points. So 88.5. That's 7 meetings. 3.5 cuts in 7 meetings. Moving over to real rates, all a little bit higher. The news here is the 30-year real rate, 2.6. The last cycle high was January 14th at 2.61. We are about to take that out. 2 more basis points. I'm going to have to put a new entry up there. Break-even rates, all pretty much well-behaved, all well-anchored as well. If we look at them from the 5 to the 30, all sitting slightly above 2%. OAS, the option-adjusted spreads, all of them contracted, and this is as of Thursday over Thursday. Looking at high yield, the higher end of high yield contracted 10%. Even triple C contracting 4.3%. Mortgage rates unchanged week over week, still rather elevated, 6.76%. Mortgage REITs not doing well at all. Annaly's not too bad. Agency down 5.28% year to date. Annaly up 4.62 year to date. ABR down almost 25% year to date. They did have the dividend cut, which they did telegraph last quarter. It only makes sense. Unless you get a 10-year below 4%, ABR will probably struggle along. For the mortgage REITs, they use a lot of swaps, interest rate swaps. Some of these will be running off, if not running off now, running off this year. So the fixed rate on that swap is going to reset much higher. So some caution is warranted here. Looking at MBS issuance, it is up year to date. If you go over to SIFMA, and you look for, under statistics, you look for mortgage-backed security statistics, you'll see that the issuance of MBS is up year to date. Still waiting on what the Fed is going to do with its MBS position. It has, what, $2.2 trillion in MBS, which it really should never have had to begin with, but there we are. We need the long end of the curve to come down. I see a deal between Bessent and Powell here. You know, you go ahead and sell off some of that MBS and use the proceeds to buy the 10-year. You want to do it anyways. We need a lower 10-year. It's in the U.S.'s best interest to get a lower 10-year because we got to refinance on the long end of the curve. There's no downside. Everybody wins here. But why this deal is not happening, why this discussion is not going on, maybe it is. Maybe it's going on behind closed doors and we don't know about it. But within the press conference, to not even have a question about the possibility of working with the Treasury on getting the 10-year down by moving out of MBS, to me seems like, the silence in the room. You know, as a researcher or as a journalist, you oftentimes listen for where the silence is. How come no one's talking about this stuff? Interesting. Powell, no change. Both higher unemployment and inflation risks, though. But in looking at inflation risks, again, only looking at one risk, tariff, not looking at the other risks, AI, which is more general purpose and affects the bigger part of the economy. PDFP, private domestic final purchase, is up 3%. This takes out a lot of the noisy stuff out of GDP and just looks at private domestic final purchases, up 3%, same as 2024. Notes that sentiment is down, reflecting trade policy concerns, but it's not showing up in the data. This is sort of the old adage of, don't listen to what an investor believes, just look at their portfolio. Even if an investor is talking bullish, if their portfolio is short, it doesn't seem to make sense, right? Look at what they're doing, not what they're saying. This is what they're saying. However, this is what they're doing. And what they're doing is different than what they're saying. Clear decision for us to wait and see. A clear decision. Those are his words. Clear decision. Not even a discussion. Clear decision for us to wait and see. Don't feel we need to be in a hurry. So much uncertainty. The tariff shock has not hit yet. Let's see what AI gives us. Okay, I'm using Gemini Advanced. They have a drop-down menu at the top corner of what you want to use. And I'm using the an experimental 2.5, which is pretty good. I had asked it to generate a word cloud for me, and I gave it the link for the video. And this is the output. You can click on here, and it'll give you its thinking. It even gives you the plan of what it wants to do. Use YouTube to get the transcript of Powell's comments. Respond to the user, providing the transcript and explaining I cannot generate a word cloud. So, can't generate a word cloud. Here's a summary. Economic outlook. U.S. is currently in a solid position, characterized by low unemployment, strong labor market. I like that it gives you the link. You can go right to it. While inflation has decreased significantly, it remains slightly above the 2% long-term target, slightly above year over year, month over month. It's way below. In fact, you had one reading where it looked like it was threatening deflation. Labor market continues to be strong, unemployment rate remaining low. Inflation has eased from its highs in 2022, but is still above the 2% objective. Now, this is where I think, I take a little bit of issue here. It is 2% over the longer term. It is not 2% every month. It is not 2% all the time. They've said this many times in the past that they don't have an inflation target. They don't target inflation at 2%. It's 2% over the long term. So it could run 2.5% for a couple of years as long as it runs 1.5% for a couple other years. So it is still above the 2% target, but you have to start thinking about, well, what's going to be the average over the next 5 or 10 years? I don't see any of that in there. I think they're way too data dependent and only half the data right now. FOMC maintain the current fund rate. Existing monetary policy stance is viewed as appropriate. Federal Reserve is closely observing the effects of new trade policies, which could potentially lead to higher inflation, slower economic growth. Monetary policy decisions are guided by the Fed's dual mandate. The Fed is committed to its goals. It says that all the time. We're committed to our goals. Tariffs and economic impact. Increased tariffs have the potential to cause higher inflation, reduced economic growth, and increased unemployment. The inflationary impact of tariffs could be temporary or more persistent. Last meeting, he brought out the word transitory again. Remember that? It will be transitory. Yes, I am aware that I'm using that word again. That word is now gone. It could be temporary or more persistent. What happened in 6 weeks where you went from transitory to, well, it could be more persistent? I think that's a mistake. The Fed aims to keep long-term inflation expectations stable, prevent a one-time price increase from evolving into an ongoing inflation issue. Balancing dual mandate, we can ignore that. Policy review, response to questions. Powell highlighted the Fed is closely monitoring economic development. Ready to act as needed. Uncertainty surrounding trade policies to potential economic effects. Fed does not need to make hasty decisions, can afford to be patient. Address concerns about potential conflicts between the Fed's dual mandate goals. Reaffirm the Fed's decisions are based solely on economic data and the outlook without political influence. That's that question came up a few times. And I do believe this, had Trump not said a single word, I think they could have cut. I think they probably would have had a bigger decision about whether to cut or not clear cut, as they said earlier. So I think we got to give the error here to Trump. Let's just go down here. How many times did he say good place? We're in a good place. 8 times. 8 times. He said good place 8 times. Economic policies in a good place. Very good place. Policies is a good place. The economy's in a good place. He used, that's the word that jumped out at me a lot, is a good place. But other people noticed that the word wait or waiting was used a lot. So I asked for that. Wait 7 times. I would have to ask it again for waiting. It said, if you want to ask me again for waiting, I'll look for that one word, but I'm not going to look for 2. Pretty petulant little piece of software. I'm not going to look for 2. I'm going to look for 1. If you want another word, you ask me again. Anyways, there we are. The other, well, I'm using air quotes here, big, as Trump would say. The other big thing last week was the UK-US trade deal. I say that with a question because only Congress can sign trade deals. So this isn't a trade deal as much as it's a trade understanding, I guess you'd call it that, or the beginnings of a long negotiation of what might become a trade deal maybe. It was big, it was huge, and I was completely underwhelmed. You look at this, you go, that's it? God, you guys must be desperate if you're trotting this out as groundbreaking and incredible, and all the people you had back there that were singing your praises. And this is, I don't know. Does anybody else think this was a nothing burger? You look at it, you go, this is nothing though. This almost seems desperate, that you needed something so badly that this was the best you had. It's like, let's get it out there and say it's the best deal that's ever been done in the history of our two countries. Anyways, here's his post on Truth Social. Today is an incredible day for America as we deliver our first fair, open, and reciprocal trade deal. It is not a trade deal. Let's be very clear. This is not a trade deal. Only Congress can sign trade deals. The president does not have the power to unilaterally enter into a trade deal with another country. That rests with Congress. It is not a trade deal. Something our past presidents never cared about. When will he drop this? Is anyone else getting tired with the whole, we got to sit through how bad every other president was first before we get to any detail about everything? What a disaster Biden was, what a disaster. Like, yeah, we get it. No one's as good as you, but can we please just skip it from here on in? It's just getting tiring. Together with our strong ally, the United Kingdom, we've reached the first historic trade deal since Liberation Day. Again, not a trade deal. As part of this deal, again, not a deal. America will may raise $6 billion in external revenue from 10% tariffs, $5 billion in new export opportunities, maybe, for our great ranchers, farmers, and producers. Hence the national security of both the U.S. and the U.K. through the creation of an aluminum and steel trading zone and secure a pharmaceutical supply chain. Well, there was no conclusion reached on that at all. This deal, it's not a deal, shows that if you respect America and bring serious proposals to the table, America is open for business. Many more to come. Stay tuned. Well, it's not a very good deal at all. I mean, if this is the negotiator in chief, the others are going to be harder and uglier. As I do this, it is 10 a.m., which means it's about 4 p.m. in Geneva on a Sunday. And I've heard nothing out of the China-U.S. talks, nothing at all. Good or bad, which I guess is good. Nobody walked out, but there is no conclusion. I'm going to show you some data in a little while that makes me believe China has the upper hand in this quite easily. And then we're going to ask an interesting question about the bifurcation of the world in terms of production and consumption. A really interesting question. But let's stick with this. Limited details so far, and as they both say, it's still being worked out. So this is the announcement of an agreement to begin a discussion about a potential deal that maybe Congress will sign in a couple of years. Let's be serious about this. That's all this was. It's not a trade deal. 10% tariffs do remain in place. So the 10% across the board tariff that the U.S. put on does remain in place. So there is no reason to believe that any other country is going to get anything lower than that 10%. So we now have at least some idea. We can be at least somewhat certain of a minimum 10% across the board. That's going to stay there. So in terms of the U.S. equity market, do you think the U.S. equity market is worth more now than before the 10%? Right? And if you think, well, no, with the 10% tariff, it's got to be worth less than it was before the 10% tariff because it's only going to raise costs and reduce choice. I would tend to agree with that. Let's see if the market agrees with that. Trump says to other countries, don't expect the same. Don't expect the same that we're giving these. So you have a minimum of 10% and could be higher. Cars and parts, before all of this, it was 27.5% because there was already 2.5% there. Threw another 25% on. Lowered it to 10% for a maximum of 100,000 units, which is what the UK imported into the US in 2024. So the UK doesn't have that 25% on cars. Every other country does. So the UK now has an advantage over every other country that's importing into the US because it's only 10% as opposed to 25% for everyone else. They will more than likely use that advantage to raise their price to be competitive with everyone else. If prices are going to go up, why wouldn't they go up as well? So I think this is a win for the UK on this one because they're going to capture what is called economic rents by allowing their price to be higher than it needs to be, only because everyone else's price will be higher. So I got to give this win to the UK on this one. UK imposes 10% import tariff on US vehicles. So, going from the UK to the US, 10%. Okay, going from the US to the UK, 10%. There you go. Rolls-Royce engines and plane parts, 0%. That is another win for the UK here. Aluminum and steel, 0%. There's another win for the UK, but there is a quota system. Also exempt are products made with aluminum and steel. There's another win as well. Ethanol imports to the UK, 0% tariff. That is a win for the US, to the extent that they can that they have a buyer in the UK, that producers in the US have buyers in the UK, to say, okay, well, 0% tariff on that stuff coming in. What if you have no buyers for it? Then who cares, right? Well, we don't know if they're a buyer. Pharmaceuticals, nothing done on pharmaceuticals, but it's still being worked out. The 2% digital services tax, there's no change on that. The UK did not reduce that. That is a win for the UK. It's a loss for the US, but it's still being worked out, they say. Beef exports to the UK, 0%, down from 20%, 0%. And the quota is now up to 13,000 metric tons, up from 1,000 metric tons. Looks like a win for the US. However, no weakening of UK food standards. And this is a statement from the UK. American hormone-treated meat will not seep onto the UK market. Well, the majority, if not all, of US beef is got some hormone treatment in it. So yeah, lower the tariff from 20% to 0%, but say, listen, any kind of hormone treatment, you're not coming in. Well, that effectively eliminates beef going in. So go ahead and raise the quota, lower the tariff all you want. Any kind of hormone treatment on that, it's not coming in. But maybe there is some farmer out there that doesn't do that, that now says, hey, now I have a new market. Yay. Off we go. Average tariff rate is dropping 1.8%. This is the average on 2,500 US products. That's a win for the US, but only 1.8%. It's not much of a win considering what you gave up. Okay, never mind the 25% on these cars for the same 100,000 cars. You now have advantage over everyone. Rolls-Royce, free and clear. Aluminum steel, free and clear. Products made with aluminum steel, free and clear. No deal on pharmaceuticals. You guys get to keep your 2% digital services tax. We can send beef in, but not if it's hormone treated, which most of our beef is. So it's like, well, who do you say is the winner in all of this? It looks like the UK kind of walked away from this one with the better part of the deal, if you want to call it a deal, which it is not a deal. It is what would you call it? A term sheet that starts a negotiation over a couple of years on a potential trade deal that may or may not happen, that the president has no authority over, but only Congress does. I don't know. I think this big announcement and this big rollout, for how little it is, to me speaks to the desperation this administration has to have a victory of any kind. If you go back and listen to that presentation and the press conference after, the first question was asked by, I think it was either an Irish or a Scottish journalist. And he said it bluntly. He says, given what we've seen here today, isn't this really just that you really needed some kind of victory somewhere? So you put the only thing you had out there, which was this? And of course the answer was, no, this is historic. It's never been done before. No one's ever seen anything like this. Everyone's talking. I'm hearing a lot of good stuff. That kind of stuff, right? All the bluster that comes with it. And because of all the bluster, and because everyone around him parrots the bluster, it's hard to know what to believe. You listen to him and you say, well, okay, come on. Is it really good? I don't know. It doesn't seem great to me. It seems, eh. And in the end, let's keep in mind, this is not a deal. Only Congress can sign trade deals. Okay, let's have a look at what's going on out of China and why I think that China probably is in a better negotiating position than the US. This is a headline from CNN. 0 ships from China are bound for California's top ports. Officials haven't seen that since the pandemic. And on Friday, the Port of Seattle announced that it has 0 ships unloading. 0 ships unloading. There's been some confusion on how to read these boxes. This is import volumes May 4th to May 10th. 75,714 TEU. TEU means 20-foot equivalents. It's a shipping container that is 20 feet long. Most are 40 feet, so they count as 2 TEUs. Ships are quoted in terms of TEUs. So you have a ship that's quoted as 10,500 TEU. It means it can carry 10,500 20-foot equivalents. So a 40-foot container is 2 20-foot equivalents. Scheduled vessels 16, change from previous week, 12% below the previous week, which was already down. This is the big one here, change from previous year, 32% drop from the previous year. This is an important paragraph here. Speaking on May 6th, this is May 4th to May 10th. Speaking on May 6th, this was in the middle of this, right? To the Port of LA's Board of Harbor Commissioners about the impact of federal trade policy, Gene Soroka, executive director of the port, said that this week a 35% drop in imports year on year was expected. So he's saying this on the 6th. It's important to understand how these numbers work, because you may look at this and say, but hang on, you're going from 75 to 86 to 103. This is not affecting anything. Hold on. On May the 6th, he's saying we expect it to be down 35%. Only by the end of the week do you find that it is down 32%, because you get cancellations. So if we look at May 18th to May 24th, you have 19 vessels that are scheduled. It is expected that some of those are going to cancel. However, it's too soon to tell if they're going to cancel yet. You don't know if they're going to cancel the port call yet. Too soon. Even on May 6th, Gene Soroka, who is the executive director of the port, still didn't have clarity all the way to May 10th, said, I expect it'll be down like 35% because there are cancellations. Here's the next statement. For the month of May, in totality, I expect 17 canceled sailings out of a schedule of more than 80 or 20% of vessel arrivals already being canceled. So this is 16 for the next week, or 21. With the expectation of cancellations, this will drop to 16 to 17. You have 19 here. This will drop to 15 to 16. And as these drop, this is where they start to show up. So you can't look ahead 2 weeks and say, everything is just fine. You have to look at where we are now, down 32% for, I think this is Long Beach, down 32%. China, this is mostly the drop coming out of China, because coming out of everywhere else is perfectly fine. The idea that the U.S. is going to have empty shelves, that's simply not true. What U.S. will have is fewer stuff on the shelves from China, but more stuff on the shelves from other places. Retailers will fill their shelves. The consumer will have less choice and may have higher prices to pay. As Trump would say, you don't need $30, you only need 3. You don't need 250 pencils, you can do with 5. It brings up an interesting question. There is a high level of consumerism in the U.S., the highest marginal propensity to consume, and perhaps it doesn't need to be that way. Consumerism isn't really life enhancing at all. That maybe stopping people from having so much choice would probably be a good thing. You don't really need $30. You don't need 250 pencils to choose from, do you? But that being said, Is that a role that you want your government to play, to determine what choices you have when you go shop? You don't need to choose from 5 t-shirts. You'll make do with 2 t-shirts. I deem it so. I don't think so, right? I think you want the free market to choose, and you want to choose for yourself. But what if you're so addicted to consumerism that maybe what you need is some tough love? I don't know. It's an interesting question to ask. Is this actually a bad thing for the economy, but a good thing for human happiness? Is it a good thing for the planet to have less stuff being made ending up in landfills? Is it? Or is your choice paramount to everything else? What's going on here in China? China exports in April are up 8.1% year over year on a dollar-denominated basis. You have a weaker dollar, which means that on a real basis, it would have to be even higher. Their exports are up 8.1%. What's going on? Exports from China to the U.S. are down 21% in April over 2024. This is stuff leaving China, going to the U.S. down 21%, but yet China's up. Why? Exports from China to the ASEAN region, most of the Southeastern Asian region, up 21%. Exports to Latin America up 17% year over year. Exports to Africa up 25% year over year. To the EU up 8.3% year over year. China is up 8.1% year over year. It's not going to the US. It's going everywhere else. China is secretly walking around the world going, you want this stuff? You want to make a deal? We'll make a deal with you. You can't count on the US anymore. They hit your country with 10% tariffs. They're going to hit your country with reciprocal tariffs. We're not. We won't do that to you. We're not doing that to you. Why would you continue to order stuff out of the US when you can order stuff from us? They're not your friend. They're not treating you well. Why hurry and make a deal with them? Look what we can do for you. Up 21%, up 17%, up 25%, up 8.3%. Make China great again. Up 8.1% year over year, down 21%. Imports of 20-foot equivalents down 32% for that week year over year. Change from the previous week, negative 12.43, without any cancellations yet. The week of May 11th to May 17th is down 12%, up 14% the week before, but let's put this chart up again next Friday. Is that a deal? Can we agree to that? We're going to put this up next Friday. I want you to remember this number. Change from previous week was up to be up 14.4. Remember that there were 21 scheduled visits. Let's see what happens when we put this up next week, of how many of those 21 actually showed up, and we'll see what happens to this 19 over here. 6 days ago, 41 vessels were scheduled to depart China for the San Pedro Bay complex, which encompasses both the Port of Los Angeles and the Port of Long Beach in California. 6 days ago, 41 vessels. On Friday, it was 0. 41 to 0. 41 were scheduled to leave. On Friday, 0 were scheduled to leave. They just haven't been canceled over the next few weeks yet, because you might get something happening this weekend, in which case ships can load up on Monday and they can actually make their scheduled visit 14 days later. But if nothing happens today, cancellations, off you go. Seattle, 0 ships. So what did Trump say about all of this when confronted with this? He said, oh, it's good. Fewer ships from China means we lose less money. We lose less money. Why? Because our consumers will pay more to get it made somewhere else. So we'll stop losing money because they'll pay more. We won't have low-cost products coming into the country. We'll substitute them for higher-cost products, so we'll stop losing there as well. Saving money. We're tired of saving money. You are being liberated from your savings. The dock workers here will soon be liberated from their jobs. when you have 100,000 20-foot equivalents dropping to 75,000, there is 25,000 that do not need to be put on trucks to be driven somewhere. So truck drivers will be liberated from their jobs. Everyone's winning. Are you tired of winning yet? Okay, let's move over to SPY. Earnings, the forward 4-quarter earnings continue their slide, now down to 270.96. The week before 271.54, slowing down but still dropping from 277 down to 270. I don't know if I've ever seen earnings drop that fast over that period of time without a recession. 56.59 on the close. That puts the index almost pretty much unchanged week over week. Slightly down 20.89, but the SPX was down by a little bit more than earnings dropped. Still, I think very richly valued. Implied volatility last was 19%, 13-week sitting at 48 percentile. I don't think we're done with that. Looking at the pace at which earnings are dropping, I seem to think 260. I continue to think 260 is where we'll see it end up, and I've got a range of multiples, 18 to 20. I seem to think that 18 is probably the right place to be, but I don't know if this market allows it to get to 18. This market just doesn't want to seem to buy anything that cheap. It does want to continue to pay more. More uncertainty, higher price. Let's go higher. Even at 20 times, it's 5,200 or 520. We're sitting at 565. At 18 times, 4680. So we're somewhere in between 47 and 52. I seem to think that in the range of 4,500 to 5,000 probably would be the right price given where we are. Sitting right now 7.73% below an all-time high, which is at 20. We were close to 23 times forward earnings at that point. To get to 520 from where we are would be another 8% down. And this is the target range based on this, 470 to 520. And I think if S&P were inside this target range, I think that would open up some opportunity for selling puts down here or even for buying the index, but I certainly am not a buyer up here. I am short the index at these levels. IWM holding above 200, but not decisively. Tried a couple of times to breach 202, 203, didn't. Down 17% from its recent high. IJR down 18%. In correction territory, but out of bear market territory, but don't close the book on that one yet. And triple Q's still very close to correction territory, 9.75. Again, I wouldn't close the book on that one just yet. Companies reporting this week, 11. SectorSpider.com has 13, but it has Fox News in there twice for 2 classes of shares, so it's really 12, but I've given up on them agreeing on anything. The important ones this week, Thursday, Deere and Walmart. NVIDIA really isn't till the 29th. That is the AI story to see if that's still alive and what is going on there. We're not going to get that till the 29th. The big risks this week remain the one guy. And then we do have CPI and PPI, which will give us some idea of inflation that may have some effect on duration. But when you think that duration should perform well because of the news, it seems to just go the opposite way. So if we get very benign data this week on inflation, if we have another month of zero or well below target, and TLT continues to sell off, I think it's done. I think at that point I would probably get a lot more aggressive on my exit because if it can't perform right when it should perform, when will it perform? As far as the market is concerned, to me, this was the right move given everything that we saw. Some rebound was in order given that reciprocal tariffs were delayed for 90 days, but it's still just 90 days. Given the dismal performance of the big first trade deal announcement, what seemed to me like, you got to be kidding, this is what we're excited about. I seem to think that 565 is a near-term high in here that I'm just not seeing why we would want to push beyond that and pay more than 21 times forward earnings for an economy run by a single individual with piss poor execution skills. I'm just not seeing it, so I will continue to be short on SPY. I am long IWM though, so I do have a net long beta position. However, I keep negating that almost on a daily basis using 0 day to expiration options to push myself into negative beta almost on a daily basis. And because there's 0 day to expiration, I don't actually need the market to go down on this one. I just needed to stay in a well-behaved range, and in the last little while it has been working to my advantage that way. If you don't know how to use the 0 day to expiration options, don't. It's not just a matter of buying or selling them and hoping for the best. There is a way to structure them so that you're looking at your overall exposure, so that no matter what the outcome is, you win. It requires a little bit of expertise and intuition. So if you don't know how to do that, my strong advice with 0 day to expiration options is don't use them. Their theta decay is brutally fast if this stuff moves against you. Okay, let's have a small discussion about AI. And I think this is going to become a more and more important topic in terms of monetary policy, because I think the Fed is missing a big move that's about to happen here. Is they're so focused on this small part of the economy, the goods side, an even smaller part of it, which is the goods that are imported, and the inflationary effect of that, and missing the deflationary effect that's going to happen with AI. I'm going to show you just a few tools that will blow you away. I've been following this stuff now for a year and a half. But a year and a half ago, I tried out this new Chat GPT thing, and I was unimpressed because I asked it some questions of which I already knew the answer to, and it was off. And over time, it started to get better, but it was nowhere near close enough. I had the subscription to ChatGPT, the $20 a month. I was paying that, and then I would try it out every so often. Again, asking questions I already knew the answer to, seeing if there's any way that I could get it to improve the quality of output that we do for the CFA side. Can it do anything for us? Not really. It wasn't correct enough, and it wasn't good enough to be a teacher or a tutor, because it risked teaching the wrong thing. It would hallucinate a little too much. Well, there are ways to sort of fix that now. But in the last couple of weeks that I've been using this for a particular task, 3 letters jump out at me, WOW, wow, of what it can do. And as I started using it, I got very concerned, almost afraid, because I will say a couple of things now that I don't think are hyperbolic. AI has the very real possibility of replacing me in 2 years. Within 2 years, you won't need me to do a market outlook. AI can do it. AI can do it for you. AI can almost do it. If you take a couple of my market outlooks and you put it in Notebook LM, and you ask it to generate something similar to it, it gets close. Doesn't have all the visuals. It's mostly voice, but it gets there. If you then begin to combine it with the ability to search other websites to be able to find the data and train it over time, and as these things get better, it will, I do believe, within a year or 2 years, it will be able to produce an entire video, an hour-long video that I already do, which takes me about 6 hours to do. It will do automatically. You can even have it do one a day, 15-minute highlight every single day. It does have the very real potential to replace me. What about in the teaching space? Yeah, that's inevitable. It is inevitable that most tutors and most teachers will be replaced by AI, but in a very particular way. You are still going to need an expert, but you're going to need far fewer experts. So what started off as just let's incorporate AI into finance has turned into something a little bit bigger. So I'm going to be adding some courses for AI in finance. How do we use this in finance? For financial modeling, for example, for reading 10Ks, for doing a competitive analysis, for doing an industry analysis, for doing all of this stuff. How do we use it? So I'm going to develop a course for that. That'll be in the applied analysis module. First videos are up Monday. I've already started narrating them today. And then every Monday I'll put up new videos. I don't know how long the series is going to be, because from where I stand as I survey the landscape of what's out there, it seems never ending. And it also seems that the improvements and the new tools that show up faster than I can keep up with them. So the first one will be up tomorrow, and I will just keep going with that, because I don't know that the traditional way of doing things in a year is going to matter anymore. It takes way too long, and AI can do this much faster. I'll give you an example here with understanding coal mining. I will be starting with these tools here: Gemini 2.5 Pro, the experimental version, Google AI Studio, and Notebook LM. I'll show you what I was able to do on Notebook LM, just playing around slightly. But let's look at understanding coal mining. I've already done 2 videos in the mining series, understanding copper mining and understanding gold mining. And with Trump signing an executive order promoting coal mining, I thought, wow, let's do one of these, so that we can take a company like Peabody Energy, read their statements, and go, okay, I see that these mines, are mining anthracite. These mines are mining a different type of coal. This is thermal coal. This is metallurgical. I know who your customers would be and what side they're on. I know how profitable each type of coal will be. So you understand the mining operations because you understand coal. These things take 3 to 4 weeks to develop a good primer, because I have to go through a bunch of company 10Ks. I have to go through the industry associations. I have to go through some research papers, and you have to read and make notes until you keep reading the same stuff over and over and over again. Then you know you've pretty much covered the field. Now you can compile your document. It's called a primer. And then from your primer, you create your slides, and then you narrate. The goal is to come up with a 20 to 30 page primer. It takes 3 to 4 weeks to do this. I could do that in 2 days with AI. In 2 days. Now, you still need an expert. You still need me to look at the output, go, that's not exactly what we're looking for here, and I need to fact check these 4 or 5 things. That if I had no knowledge at all of coal mining, then it wouldn't be such a great marriage. A non-knowledgeable person with an AI agent is not as good as an expert with an AI agent, because you have to make sure the output is correct. That is called having a human in the loop. Always have a human in the loop. So you can have AI and an unknowledgeable user. This is a dangerous place to be. What you want is an AI plus an expert that produces output, which then gets consumed by a user. If you have this, the user is, as a non-knowledgeable user, is in no position to determine whether the output is correct or not. I have an AI tool teach me a different language. It says, here's the word for bird. I have to say, well, if you say so, because I don't know. But if I already knew the language, I could look at it and say, well, it kind of is the word for bird, but not quite, right? So I'd know the little bit of nuances, and then I could correct the AI tool such that the next person who used it to learn the language would have the expertise within it. But in using it, you run into the risk of something called learned helplessness. You can Google that, learned helplessness, that you rely on something so much that you no longer know how to do it yourself, and that you don't even know if it's correct. I've seen this lots of times in education. The more technology you introduce into the classroom, the lower the performance of the students, because there is this psychological belief among the students that, oh, most of the work is done for me. I can relax a bit. I don't have to work as hard. And then they end up being less and less informed the more technology you give them. So AI does have the very real potential to create an army of learned helplessness, of users that have adopted this learned helplessness. So you do need a human in the loop. However, 3 to 4 weeks down to 2 days, come on, you can't compete with that. So what has that done? That has eliminated the need for me to hire 3 or 4 people that otherwise as analysts would have been hired at 100, 150 a year. You don't need them anymore because you can get this done. And once you have a template on how to produce this, you can go from sub-industry to sub-industry to sub-industry to sub-industry in no time and produce this. Not only that, I can give the AI tool some references. These are called shots. I can give it references of saying, here's an understanding video I did, here's another understanding video I did, another understanding video I did, and here is this document. Produce my slides. Produce my slides along the lines of this, and it will. Now I can say, narrate these slides along the way that I've narrated, and it can. And I can give it a document, and I could say, have a discussion about it, and allow me to join the discussion and ask questions about it. Become a personal tutor to me in this sense, and it can. I don't think ever been as concerned as I am now, and just looking at the speed at which these things come out. The new Gemini 2.5 experimental is so much better than the previous 2.5, and it's just a test right now, and it's just better. These models won't stop. They will continue on. There was a really good presentation done on Marcus Academy about how it's going to displace workers, and I will draw that out on the next screen. We'll look at an equilibrium of how it's going to replace workers, but it will. Why the Fed is not, why this is not part of the discussion on monetary policy, I do not understand. I don't understand this. This is the real threat. I've always been saying that I think rates go lower because we do live in a deflationary world. Technology is deflationary. What you need is a general purpose technology. It is here. It was not here a year ago. It wasn't ready. It is here now. If we take 2 people, let's put a timeline out here, and we start them out at time equals 0 with a new technology. One is very knowledgeable, one is an expert, one is a non-expert. In terms of being impressed over time, it will look like this for the non-expert. Wow, I'm impressed. Whereas the expert will be, not so much. No, hang on, it's starting to get better. Wow, I'm impressed. We are at this inflection point now where I am impressed. So it may seem to this person over here, oh, you're just figuring it out now. No. I had figured it out already, and I had figured out that it wasn't ready yet. Now I'm figuring out that it's ready. So that's where I am now. This thing is at that inflection point where I would be very, very concerned. I think the future of what I do for the market outlook, for the applied level, is not going to eliminate me, but is going to dramatically reduce the time it takes me to do this with the use of AI. But you're still going to need a human in the loop. You're still going to need an expert. And I'm going to show you where you need the expert here first. Let's move over to Notebook LM. I have it up here. Let me tell you what I did. This is level one ethics. I took the first two standards and I put them into Notebook LM and generated a podcast for it. And it was okay. It was okay. What I found was if I went back to the document and I edited it, so you go back to this PDF that you put in and say, well, I'm an expert. Let me go through it. Okay, you don't need this sentence. You don't need this paragraph. You don't need this. You don't need this. This sentence is not clear enough. Let me add another sentence. So if I just go and I fix up the source document, I end up producing output that is much, much better. So you can generate a podcast, which I did, Ethical Standards for Financial Professionals. And then it has this interactive mode. Now I want you to think that you just imagine you could take a chapter from a textbook or a 20-page PDF from an industry association and put it into Notebook LM and say, you know what, I'm not big on reading and I'm not big on listening to the text being read to me. But when I listen to two people having a conversation about a topic, I get drawn in even more. Do you find that works for you? You listen to two people talking and they're feeding off each other. You learn more and you remember more from their conversation than just somebody reading a book to you, right? Well, that's what this thing is meant to do. So after you clean it up a bit, it gets better. That's the role of the expert. The role of the expert is saying, okay, here's the inputs. Let me really work on the inputs for you. The outputs are going to be fantastic. I'm going to let you listen to just a bit of this conversation here, and my microphone is going to have to pick it up because I didn't set up my my screencast to grab internal microphone. So if it sounds terrible, that's just because I'm twisting my microphone around really slowly here so that you can hear it. Ready? Let's just listen to a little bit of it.
And more than that, if you have reasonable grounds to suspect illegal or unethical stuff is happening or about to happen, you have a duty to dissociate yourself from that activity.
Dissociate. That sounds like a big step. What does that actually mean in practice?
Well, it can vary. It could be as simple as ask.
I'm sure for you CFA candidates out there, you all remember that. Some of you probably have broken out in chills and a small sweat. There's this interactive mode. Let me show you what happens here. You enter interactive mode, and what I can do is I can ask it a question. I may have to give it some permissions up here, but play audio.
We're focusing solely on standard I for this deep dive. Thanks for keeping us honest.
Okay, where were we?
Now, what I can do is I can join the conversation at any time. I'll play audio, I'll join, and I'll ask a question. And I can ask it any question I want. And because it has this PDF with all the information in there, I can ask it for clarification about certain things. And I can continue interacting with this thing for as long as I want, like a tutor. Let's ask it a question. We'll ask it about, we'll ask it what standards it's covering, and then we'll ask a question about one, just so that you can get an idea. And again, I'm sorry if you're not hearing the computer audio as it comes out. I'm trying to get the microphone to pick it up. Let's give it a shot.
Where were we? Ah, yes. Standard I and knowing the law. It's not just about knowing.
Oh, go for it.
What standards are you covering in this podcast?
That's a great clarifying question. Today, we're focusing exclusively on Standard I of the CFA Institute's Code and Standards.
Right, and within Standard I, we're diving into 5 key areas to really unpack them for you.
Specifically, we're covering IA, which is all about knowledge of the law.
Then we'll move on to IB, looking at independence and objectivity.
Following that, we'll tackle IC, concerning misrepresentation.
And after that, we'll delve into ID, which covers misconduct.
Finally, we'll wrap up.
Oh, go for it.
With respect to misrepresentation, what if I say something wrong, but I don't know that it's wrong? Is that misrepresentation?
That's a really important nuance to clarify about misrepresentation.
Absolutely. It brings up the question of intent, doesn't it?
Exactly. According to the materials, a misrepresentation involves untrue statements or omitting a fact that's false or misleading.
Okay.
The key word there is knowingly. It says a member or candidate must not knowingly omit or misrepresent information.
There you go. Now, I want you to think about that for a minute. I put this PDF into there. I generate this podcast. Now I can interact with it like I've got two experts right there for me. Right there for me. So if you have an industry association and it has a 20-page document on a particular topic, you can put it right into Notebook LM. You can listen to the podcast, and every now and then you can stop and say, hang on a second, I'm a bit confused. You said this. What do you mean? And it'll answer that question for you. With this in mind, I want you to think about your own job. I want you to think about the career that you want and where it is that you're going and the people that you have working for you. How many times have you turned to the people you work for, say, hey, can you get me this? Can you get me that? Well, now this can do it for you. Or if you were the person being asked for something, now the person asking you doesn't need you. Microsoft has made a bold statement of saying that 95% of their code by 2030 will be written by AI. 95%. How many engineers does it need? 95%. I believe that in a couple of years, probably 70 to 80% of accountants will be obsolete. Half the auditors will be obsolete as well. All you need is a lead. You'll need one lead auditor with 15 AI agents, all performing. So you do receivables, you do this, you do that, you do this, you do that. You'll still need a human in the loop, but you won't need 15 auditors. You'll need 15 AI agents. If you don't get on board this stuff now, this stuff is leaving, this train is leaving the station. I'm telling you, you got to get on board now. A year ago, if you said, do I really need to learn AI? I would have said, nah, some of it's kind of neat, but it's not useful to me just yet. When the expert shows up and tells you to be afraid, be afraid. If the unknowledgeable person shows up and says, this is really cool, then it's like, oh, maybe it is really cool. But not until the experts start getting worried do you need to get worried. I'm an expert and I'm worried. I'm worried for many of the other quasi-experts. You're always going to need an expert, always. Because I've seen, and really I've only cleaned up this document once. I can see now after interacting with this tool that I can clean up this document a little bit more. That's where the expert comes in cleaning up this document. Now, I want you to think about this. Well, where's the time saved if you got to clean up the document? Well, I clean up the document, and now how many people who have access to this document, once I have this document done, you give this document to Notebook LM, you generate your own podcast, you have your own personal tutor that I've trained, that I've given the parameters for by having the written document that it then helps answer your questions. I don't have to answer 500 questions from 500 candidates. Ask your question to the two people talking. I only have to do it once. But as far as a teaching assistant goes, boom, done. How many teaching assistants are you going to need across universities? How many universities are you going to need when you have this? The ability for you to learn anything, anytime. And as you're learning it, you become more of an expert. You then begin to be able to modify the inputs yourself to get even better. As we go through the course, I'm going to show you how to raise the level of difficulty on the output that you're getting. That if you're already an expert, you don't want juvenile stuff and you don't want to be talked down to. You want the AI to be more of an expert than you. I'm going to show you how you can get it to pretend or to talk to you from a position on which it knows more than you. That's terrifying. Anyways, let me flip back over here. This is going to start, the first video is up on Monday. It's going to be an applied analysis, and it will go through as many tools as it takes to get the point across. The goal of all teaching really is to get to the point where the student no longer needs the teacher. And I think of all the time that I've been doing this, this is the first time I really have the real potential to deliver to you something at which the end of you will then say, I no longer need you. That's success. So my success will be based on how many people leave me and never come back. So that starts on Monday. On the next screen is it's just a repetition, really, of something I saw on Marcus Academy. Somebody was introducing AI agents and what happens to wages and employment before and after the introduction of AI agents, and I think it's important. Okay, what I'm going to show you here is sort of a really nice equilibrium chart that I have borrowed from an episode of Marcus Academy, where somebody was introducing a change in the workforce or in the composition of the workforce as AI improves. And I think it's a really interesting thing to go through. So let's, let me just recenter this here. Let's draw out, let's see, there we go. I'm going to draw out just a graph for you, and I will lead you through the whole step. Let's say that we have individuals that are endowed with a certain ability, a certain level of knowledge. And here we're primarily going to focus on knowledge workers. So there's some distribution of knowledge, and there is some cutoff to this knowledge below which you are a worker, above which you are a solver or a manager. So we're introducing the notion of hierarchy, where you enter an organization as an entry-level employee and you rise in the organization until somebody says, well, this is about as skilled as you can be, and the more skilled people rise to higher levels in the organization. So we're just going to have an organization with two levels. Either you are management material or you're not. And we're going to put a 45-degree line in here, and this is the output per worker, or the expected output per worker in isolation. However, workers do have managers, so they can be more productive, and workers have other workers around them, so they can work off of each other. They can give each other ideas, help each other out. So there is some value to this. So if we plot the wage, it would tend to look like this up to this point. This is the cutoff point. And above that, you're a manager, so your salary, your wage increases, and your wage is a function of your knowledge, and this is the distribution of knowledge from 0 to 1, Z. The more knowledgeable you are, the more valuable you are to the organization. I don't think that is controversial at all. Now let's introduce AI. And AI also has a certain amount of knowledge and a certain amount of ability. When it first showed up, it was very low. It really wasn't a threat to a lot of workers. Some very, very routine cognitive jobs could be displaced very, very quickly. And this really showed up in coding, especially lower level coding, function calls, database calls, things like that. And AI started to get better. So its knowledge started to get a lot better. And the most recent versions of the LLMs, Gemini 2.5 and the 2.5 beta, that will blow your mind. The new OpenAI's model, that's incredible as well. I'm going to, through the course, show you all of those. It starts to increase in its level of knowledge. Which means, let's say that we're at this iteration here. So it shifts the wage curve downward. And then there is some level of knowledge over which, you know what, the AI is just as good as the human's just as good as the AI. Above this level of knowledge, it isn't that impressive. It's just as good as a human. And then there is some level here on which the human starts to get better. So this is the new line for the wage given AI. AI replaces workers in this over this period or over this distribution. Over this distribution, you're indifferent between the AI and the worker, and then beyond here, you are using humans. So there will be, based on the models today, there will be some loss of need for the humans at these lower levels of knowledge distribution. If we, let me just back all that up, and let's just remember this green line here, and let's fast forward a couple of years, and what we'll do is we'll increase the knowledge of the AI and its ability, because it won't stop. I am based on using it like a year and a half ago. I asked it some questions of which I clearly knew the answer. Some of it was okay. Other stuff was, okay, this is way off. It's too far off. Not today. If you ask it in the right way, once you learn how to talk to it and how to ask it questions, wow. That's all I can say is wow. And when I show you what it can do, you will be blown away. But let's bring the level of the AI up. Let's fast forward 2 years, and it is more knowledgeable. Well, here is your distribution. At this point, function of knowledge is this way here. AI agents, here you are indifferent, and here you have the humans. The realm of humans is shrinking. Now this, again, let me stress, this is for routine and non-routine cognitive work. Now, routine cognitive has been replaced over the last couple decades slowly. That has slowly been disappearing. But now we're entering the realm of routine non-cognitive. So we talk about autonomous vehicles, especially semis, Class 8 trucks, replacing there's 3 million truck drivers in the US, replacing the majority of them. I see AI in a couple of years replacing the majority of accountants, not bookkeepers. That's already been done. A lot of bookkeepers have really disappeared. We're talking accountants. A lot of accountants. AI will have the ability to make a lot of judgments. AI will have the ability to audit very quickly. It won't stop. So you have got to get yourself into the right tail of this distribution now. I would say that over a period of, well, let's break it down into physical and cognitive. We go to university and we get degrees so that we can work in a cognitive field. When we talk about AI for finance, this is really a cognitive field. A lot of the stuff we do is routine. We can automate a lot of that, but we think as an analyst or as an asset manager, you can't replace us, can you? I would not be too sure of that. I am going to show you in going through this how I was able to reduce 3 weeks of work, what normally takes me 3 weeks, into just a couple of days, only because I was learning how to use the AI tools at the same time. Now that I know how to do it, I can take these 3 weeks and I can squeeze them into 2 days, 2 honest days. I want you to think about that for a minute. 3 weeks down to 2 days, and if I was going to hire a couple of people to help increase my output, how many people do I need to hire now? I just need to hire some AI agents and pay the subscriptions. Not only that, it gave me the output that I need, which usually is about a 20 to 30 page document that I need to teach from. And then I create a video around a sub-industry. Well, AI can create all my slides. So there's about 2 days gone. AI can do that in 10 minutes. And then I can just adjust what AI has done. AI can get me 80% of the way there. I can finish it. Let's say I need a graphic. AI can give me a graphic. It might take me half an hour to lay out a graphic in PowerPoint. AI can get it done in a couple of seconds. Well, now you're going to need a video. Well, guess what? AI can generate that video for me. I don't need to narrate that. AI can generate that video. I can look at the text and I can modify the text where it needs to be, and done. What other teaching tools? What about a podcast between two people talking to each other about the very video I just did? I can get that done in about 4 to 5 minutes, as opposed to going through multiple runs and multiple takes with another knowledgeable person and learning how to read each other to go back and forth. So within 3 to 4 days, I can create what otherwise would have taken 5, 6 weeks. Now, if I'm using this and I'm doing this and you're not, you're going to wonder, how is he producing so much output so fast? How is he getting this done? If the person on the desk next to you is using it and you're not, your manager is going to say, why are you so slow? And you could say, I'm working 12 hours a day. The guy beside you is working 3 and doubling your output. Now, I'm not saying this to be hyperbolic. I was skeptical when I started, and I showed somebody a neat little way to generate study tools that took about 7 or 8 minutes. And not only did it take 7 or 8 minutes to produce the output, but you could interact with the output like it was a tutor. You could press a button and ask a question, and based on the content that you gave it, it would answer. Then you could say, I didn't understand the answer. Answer like I'm in high school, and it would answer you in a much simpler way. You could then say, I didn't understand the answer. Answer me like I'm in grade school, and it would lower the explanation even more, all with the same input. You will be blown away by this stuff. I say this. Let's just go back to the physical and cognitive, just so that you know why I'm saying it this way. Let's take physical. Let's take things like electrician, plumber. You don't have to worry about AI. Not really. AI will make you more useful in that if you have a situation that you're looking at and you're saying, I can't quite figure this out, you may be able to use AI to come up with ideas, or for AI to describe the solution for you. Or you scan a part and you have AI go shop it for you while you continue working. AI will then, it can even send emails to suppliers saying, do you have this part? Do you have this? How long will it take? It'll come back with the solution, and you'll have a part on its way to you. You don't have to send that to the office to get done. Same electrician, plumber. With the advent of humanoid robots, you do have to worry at some point. But I'm going to say it's 10 plus years before you really have to look at it and say, But it's more of an opportunity for some people, because then you could say, I don't need to hire average plumbers and average electricians because that's all I can get. I can buy one of these humanoid robots and download the plumber application for $5,000, and for $35,000, I own the employee. I don't have to pay them health care. I don't have to pay them. I own the employee. Yeah, in time, you are going to have to worry about this. But cognitive, and let's say non-routine cognitive. Now, I have a PhD, and I consider myself quite intelligent, not just knowledgeable. Just to give you a recap of the difference between the two. Knowledge is that you know A and you know B. Intelligence is that if I know A and B through inductive reasoning or deductive reasoning, I can conclude C and even D. Somebody who is knowledgeable but not intelligent would not be able to get to C and D, but you could explain C and D to them, and that becomes part of their knowledge base. But they don't have the ability to generate. This is where AI is going. It's not just knowledge. So when we say that AI is down here, it is replacing a lot of individuals right now, routine cognitive, routine or non-routine cognitive, that rely a lot on the amount of knowledge they have, but don't quite have the intelligence to go from I know A, I know B, hence C and D must be true. But once they know C and D, they know it, but so does AI. This is where AI is going to get to artificial generative intelligence, that they could generate this on their own. And I am seeing with some of these new models that they do have the ability. I don't have to tell them C. That I can give them input of A, and I can give them input of B, and I can say, and I did this for understanding coal mining, given this type of coal, and given the uses for this type of coal, contrast the costs of extraction for the two. Well, that's nowhere in the description of the types of coal, but it knew enough to understand how deep in the ground it had to be that type of coal, and from that could extract out the costs of what it would take, and from that concluded a hierarchy of prices that must exist in the world, and that is true. That hierarchy of prices did exist. That's some form of intelligence there. I would say that based on the pace that I've seen over the last year, it is not unreasonable to assume that about 50% of most of these jobs can be realistically gone in 2 to 3 years. In 2 to 3 years, a research firm that might have had 10 analysts will only need 5. An accounting firm that had 50 accountants, I think, probably might only need 10. I see a lot more jobs disappearing in something like that, because a lot of that is rules based. A lot of it. So this is so critical, is if you are not at this end of the distribution, you have to find a way to get yourself into this end of the distribution. Now, this is the distribution of knowledge, not necessarily intelligence. While intelligence is difficult to increase, it can be increased over time. It is difficult, but it can be. Knowledge can be increased over time. The model that I showed you just assumed that the distribution of knowledge was endogenously given, which means you are endowed with a certain amount of ability, and that's it. But there are models of endogenous knowledge distribution, which means you can increase the level of your knowledge. And if you cannot increase the level of your knowledge in terms of I know A, I know B, and from that I can figure out C and D, then you better augment it with AI that can do it for you. So to not learn AI and AI tools as an aspiring analyst or an asset manager at this point in time is the same as going back to the early 90s and saying, this spreadsheet business, yeah, I'm going to take a hard pass on that. Back then it was Lotus 1, 2, 3. That became an absolute necessity at this point, to show up somewhere and saying, yeah, okay, I can do all that, but listen, I know nothing about Excel, never opened it in my life. The shock and awe that you would generate in a room of people by saying that. In about 2 or 3 years, that'll be the same shock and awe that you'll generate in a room by saying, I've never really used AI. You're not going to be productive enough. It is going to be the cost of entry. One interesting statistic I heard, being that we're all in the graduation season now, is the number of graduates without a job, without an offer at graduation, is hitting record levels. It's never been this way. You can say, well, there's a lot of uncertainty in the economy, but I think it has a lot more to do with AI and companies that have already embraced AI and started using AI. So again, in the short period of time that I have given it serious consideration, started using it, and especially after learning how to use the tools, how to interact with it, how to ask it questions, I am blown away to the point where I can see in a couple of years that AI would replace me entirely. And that's a terrifying concept. I've made a good life for myself. I'm good. I'm comfortable. That if AI replaced me, I would think, okay, well, let's go right off into the sunset and enjoy my life. But if I were 25, I would be terrified, which means that I would be throwing myself into nothing but learning AI for the next couple of months, and seeing if there is a space for me as a manager of a bunch of AI tools instead of being replaced by AI tools. I have to be with the humans, and not down here, because once you're replaced there, getting back in is going to be very difficult, because the AI tools are going to progress in the coming years faster than you can, which means you've got to get in on this now. I can't even tell you how critical this is.